Good afternoon. It's Jeff Quartermaine here from Perseus Mining. I'm the Chief Executive of the company and Managing Director. Perseus is an Australian company that is focused on the African continent, where we have 3 active mines and a number of development projects that we're pushing forward up to into the development phase over the next couple of years.
Jeff, thank you very much for the introduction. Clear as always. MD and CEO, I love that mixture between the kind of the Australian version of, the Australians call it MDs and all that kind of stuff, and the Americans call it CEOs. So you've just kind of given yourself both titles. But you used to be chairman as well. What's going on?
Well, I was the executive chairman. I took over last year when our chairman stepped down and into the executive chair role. Now, I've never believed that was a good idea, and my primary task this year has been to find a non-executive independent chairman to take that role, to allow me to go back to an executive role. And that's exactly what we've done. We appointed a very eminent member of the mining fraternity, Mr. Rick Mennell, to the chair earlier this year, which has allowed me to resume my role as CEO and Managing Director.
Good. And you're here today on the back of your quarterly results. You've got a nice presentation on the website. Do you want to just kind of give us a top-down view of kind of how you see the most important aspects of this quarter, your work there?
Yeah, no, look, I mean, it's another very good quarter, and it continues to reinforce the point that we are delivering on our promises and putting ourselves into a very strong position to continue to fund growth, continue to return capital to our shareholders. So we produced a slightly more than we did in the last quarter, about 121,000 ounces of gold. The important point was our all-in site cost was around $1,200 an ounce, giving a margin of over $1,000 per ounce for each ounce produced, which led to cash flow of $127 million for the quarter, giving us a cash balance at the end of the period of $643 million US. So, quite a substantial performance, continued growth through the development of our projects, and continue with our capital management strategy that saw us declare a dividend of 5 cents per share last year and announce a maiden share buyback of $100 million, which we've set about putting in train right now. So it has been another good quarter, more of the same, and that's continuing on into the next period as well.
So if I understand that right, costs are relatively flat, production more or less flat, I mean a little bit up, but with the rising gold price, your margins have increased.
That's exactly right. The margin has increased. The costs actually went up a little bit this quarter relative to last quarter. As we flagged last quarter, we were going to be doing a lot of stripping work at the Yaouré mine to get ourselves back on schedule. So that led to a slight increase in the cost this period. But notwithstanding that slight increase, the margin was very, very healthy due to the rising gold price. Now that increase in cost should start to fall back in the current quarter as we get back on track and as we reduce the number of tons of material that we're moving at the Yaouré mine.
Just on the detail of it, on your slide about Yaouré, you talk about kind of problems with the mining contractor. Is that not just? I mean, that seems to be something different to the increase in stripping tons.
Well, I'm not sure I quite use the term problems with, but certainly we did fall behind in our waste stripping for one reason or another about 6 months or actually more than 6 months ago. And we needed to get back on track. So it meant that for the last 6 months or so, we've needed to move more material than we were planning on doing in order to get back to mining the material when we said we were going to be mining it. So what actually the contractor did do this quarter and then last quarter as well was to bring additional equipment to the site to be able to increase the amount of material that they are moving. Having done that, we're settling back to where we were before.
Okay, good. And coming kind of stepping out of the detail back to the kind of the top level, the dividend policy and kind of returning capital to shareholders. You said kind of 5 cents was the dividend per share last year.
That's correct.
How long have you had a dividend in place, and how do you see that developing as a kind of a strategy going forward? So, what's the board policy on that?
Okay, well, we've been paying a dividend now for several years, and the basic policy has been that we would declare a dividend that equated to a 1% yield at the end of the reporting period. And if we had additional capital available, we would increase that through a bonus dividend. So this year we paid 5 cents a share, which covered both the 1% base plus a 1% bonus, given that we had a very good year. Now, our shareholders are located all around the world, and as a result of that, they have very different tax bases and requirements from that point of view. So many shareholders were saying to us, well, we certainly appreciate the dividend, but we would also like to see you embark on a share buyback, because from a tax perspective, that's a better way for us to receive capital. And so we have, for the first time, announced the share buyback as well. So we've committed to buying $100 million worth of stock over the next 12 months. Now, we've put the plan in place. I have to say we haven't bought a huge amount of shares just yet, because we actually in trading blackouts, around the quarterly, around the full year results. So we can only trade when we, aren't in possession of inside information. So it means that it's not a regular, buyback on Monday sort of thing. We buy stock when we can, and principally the philosophy is really to buy on weakness, as it were, where there are more sellers than buyers. We'll step into the market and hold the price, rather than be standing in the way of people who want to buy the stock.
And in terms of volume and turnover of your stock, what does that $100 million represent? Is that a lot of trading days, or it is something that's going to that you could do relatively quickly on a big day?
Oh, well, we could do. However, we tend to, we've put in place a sort of a policy around the thing, and we limit ourselves to a certain amount each trading day. So, no, look, there's more than enough days in the year to spend $100 million. Let me assure you. But no, look, it really is. It needs to be done sensibly, and used in a way that benefits all shareholders.
Okay, good. Just on the cash flow, you mentioned $127 million kind of cash flow. Later in the presentation, you talk about your cash balance rising by $56 million.
Yes.
Can you explain the difference between those two numbers, please?
Yeah, broadly speaking, that cash flow is cash flow from operations, and so we pay taxes, we invest in acquisitions, we have corporate overheads, etc., etc. So the operating cash flow, as opposed to the movement in the balance sheet, does take into account those other items as well.
Okay, so in almost you come the freest of the free cash flows would be the 127 less the taxes, less the corporate overhead, and that would kind of give you a chunk of change. Whether it's, at a minimum of $56 million, but since you've made some investments, it'd be higher than that, which is your true free cash flow.
Yeah, that's exactly right. And so the other way of looking at it is we use for our reported costs is what we call all-in site costs. Now, if you take the difference between what we sell for, our all-in site cost margin, multiply that by the number of ounces that we produced, that's the operating cash flow. Now, that all-in site cost takes into account the cost of production, payment of royalties, payment of sustaining capital, but it doesn't take into account exploration, payment of corporate taxes, investments such as we did during the quarter. We bought an interest in Predictive, for instance, or corporate overheads. So, but very close. If you back out those things, the movement in the balance sheet lines up exactly with the disclosure that we make. And this is different to the all-in sustaining costs that the World Gold Council talks about. And in our release today, we showed the things that make the difference between our all-in site cost and our all-in sustaining cost. In fact, this quarter, for instance, our all-in site cost was $1,201 an ounce, and I think the all-in sustaining cost was about $1,000 an ounce. And the difference is investment in stripping and things like that normally gets capitalised, and we explain that because people find it difficult to make earnings predictions based on our cash costs because they don't have insight into the non-cash items. But we do this very deliberately because as a business, cash is the key to us. Our mission is to generate benefits for all stakeholders, and if you exclude shareholders for a moment, the benefits that are sought by host governments, host communities, employees, suppliers of goods and services, all of those benefits require cash. So that's why we focus on cash as a business. And of course, shareholders receive cash through dividends and share buybacks, but they also receive non-cash capital gain on the shareholding as well.
Okay, talking about cash, and we've kind of mentioned, if you keep your costs steady and the gold price rises, you kind of get a growth in margin. But the other aspect of a cash business in mining sense is depletion of resources and kind of mine life. So we've got existing operations and we've got new projects. Just first on the existing operations, can you just kind of provide a quick reminder of the mine life of your 3 operating mines, please?
Okay, well, the largest of our operations is the Yaouré mine in Côte d'Ivoire, and it has a mine life ahead of it. It will have a mine life ahead of it of at least 12 years, but quite possibly a lot longer than that. We're about to take an final investment decision on developing an underground mine off the side of one of the pits, and assuming that we're going to do it, and I can say with a high level of certainty we will, that provides for about a 12-year mine life. But as we get down there, we'll drill further and I dare say find more reserves and continue that life for quite some time. So that's quite a long life asset. The Edikan mine has about 3 to 4 years of mine life ahead of it as we speak, although the reserve provides for a longer life than that because the reserve includes some material that also could be mined from underground. Now, I think Edikan's going to be one of these mines that, has always got 3 or 4 years ahead of it for quite a number of years as we find satellite deposits and as we do various cutbacks and things of that nature. So but as it stands today, it's relatively short. Similarly with Sissingué, as we stand today, it's a relatively short 3 and a bit years from now. But the thing is, so that takes us out to 2027. And in 2027, we do expect that the Nyanzaga project, which is the project in Tanzania that we acquired earlier this year, will be producing gold. Now, we're about to take a final investment decision on that project at the end of this year and put it into development in January of 2025 with a construction period of about 18 to 20 months. We'll be starting commissioning in late 26 and hopefully producing gold in January 27. So as Edikan and Sissingué start to tail off based on the current reserves, we'll have the Nyanzaga project coming on stream and more than replacing those mines in our overall production profile.
So Edikan produced 48,000 ounces this year. So it's just under kind of like it's 190,000 ounces, kind of roughly, if you multiply that by 4.
Yeah.
And Sissingué about kind of 70 to 75,000 ounces roughly.
Right. Yeah.
So you're kind of up at around 265 to 270 roughly from those two kind of contribution on an annual basis.
That's right.
And they may continue. They may, as you said, that you might get a kind of a rolling 3 to 4 year life continuation. What's the Nyanzaga predicted to come in at?
Well, look,
on an annual basis?
We'll put out a comprehensive life of mine plan when we take that investment decision later this year, early next year. But it's going to be in the range of 200 to 250,000 ounces a year for the first few years, and then tail down after a period of time. So the production out of that first year of the first few years of production will more than offset what we lose from the other mines in that period of time. And then, of course, we have other things that we'll bring on stream sequentially. So at the present time, we have the Maya Sand project in Sudan, which is currently on hold given pending a resolution of the dispute in that country. And we've recently bought a 20% interest in Predictive, which owns the Bankan project. Now, there's a lot of water to go under the bridge on Predictive, and there's no saying for sure that we will actually seek to acquire that asset. But, in the event that we did, for instance, that would make a very suitable project to bring into construction immediately following the Nyanzaga. So what we're aiming to do as a company is to have a pipeline of development projects that will ensure that a shareholder looking at the company can see have a line of sight to production of 500,000 ounces a year plus for, as long as they can actually see. So that's basically the aim of what we're about to do. So, we've been working fairly hard this year to build that pipeline of opportunities.
And of course, that's a kind of a stable operation. And you as the CEO will say that your company is cheap. I mean, we spoke about this a little bit last time, saying, but it's also, being a kind of a good value company is great. It's a something to attract shareholders. But we also touched on the fact that it's a kind of, if you're perpetually cheap, it can be seen as a kind of a slight problem. When you're consistently cheap relative to your peers. Where do you feel as if you're sitting on that kind of value? I mean, if you look at that your share price, I had a look at it. The 1 year share price has got a kind of steady growth on it, and I thought, oh, that's interesting. What's going over 1 year? And then I look at 5 years, and it's very much the similar profile. So, congratulations, that looks good. I just wondered if you can improve against your peers, and kind of where are you against your peers at the moment?
Oh, well, I think we still carry an African discount. There's not too much doubt about that. And I think, for instance, if you look at, well, it depends which measure you look at, but if you look at, say, price to earnings ratio, we trade on about 7.6, I think, at the present time. Might be slightly higher than that, given the appreciation in the share price in the last few days. That's well below our Australian peers, for instance, which are trading at about 15, 16, I think, on average in the peer group. And even other African operators, if you look at that peer group, it's well in excess of ours. But I think that, there is a growing appreciation for what we're doing. I think the thing that has held us back in the past has probably been a question mark on asset quality, so to speak, because two of our mines have not been particularly long life assets. But the fact that we've been able to bring into the portfolio assets that do last for 10, 15 years, is an enormous boost. And the other thing that I think is starting to gain some traction with investors is that we run a portfolio of assets that multi-jurisdiction, multi-mine. So that means that, it takes the volatility out of our earnings over a period of time. So there might be one African country that is having troubles politically, but the other 2 or 3 countries that you're operating in fine. So, and so similarly, one mine might be struggling, the other 2 or 3 mines are going very well. So over a period of time, you take that volatility out. And I think that certainly in the last 6 months, when there's been quite a lot of publicity around places like Mali and Burkina Faso and threats to remove licenses and things like that, people have come to realise that having all the eggs in one basket's never been a grand idea. And then particularly for an African-focused company like ours, having all of your assets or your investments in one country is quite a risky thing to do. So we're presenting to the market a diversified portfolio. We're presenting a portfolio that's been consistently strong now over quite a number of years. And when you look at the earnings and the cash flow and the production that we've been able to achieve consistently over the last few years, some investors say, look, that's really good, but we're worried about you being in Africa. And I say, well, these results have been produced in Africa. So what are you worried about? So, I mean, where's the problem? Because we do manage that risk reasonably well as a company. We've been on the continent now for quite some time. And I think that over that period of time that you refer to with the steady growth in the share price, investors have started to come to trust management's judgment and started to trust the portfolio and say, yep, these guys can continue to deliver benefits for us over a long period of time.
When I spoke to a couple of funds in the UK, in London, earlier this year, one of them was a very big fund, and they their view was kind of a micro cap was anything under $6 billion. And they said all of this kind of the detail of these mining operations is just kind of too much noise for them, and they were much happier playing in the big diversified kind of royalty companies, which kind of spreads risk across or reduces risk by spreading its exposure. Things like Franco-Nevada, which are kind of a huge market capitalization. But of course, they're more expensive. That's their choice. They go from kind of a more expensive thing. And we come back to your Australian peers. We come back to kind of your African peers. If you're trading a discount, is there any strategy you can think of how to close that discount at all to make yourself less cheap? Or is it just deliver?
Well, it is deliver. Look, this has been the question that I've asked myself many, many times a day for a lot of years. What do we need to do to be able to receive the appreciation of the market that we think that we deserve? And actually one of our mutual friends gave me some advice several years ago. I asked him, what have I got to do? And he said, my friend, you've got to do three things. You've got to execute, and execute. And I thought, well, thanks very much for that advice. But he was 100% right. And that has really driven our philosophy, in recent years. We say, look, let's just focus on getting this right, focus on doing a good job, focus on being consistent producers of cash, and the rest will look after itself. And that is exactly what is happening. And it's a case of saying, well, look, if you don't believe me when I'm saying about the future, take a look at the scoreboard. Just see what we have actually delivered in this place where you're concerned about risk, and then see if that's a reasonable position to be taking. So it is about execution. It's about delivering on promises. It's about doing what you say you're going to do. And they're all things that are central to our core values as a company.
Jeff, thank you very much. It's been a great update. I'm looking forward to seeing the new Nyanzaga plan in the year and checking on your delivery on the next quarterly results. Thank you very much. Good talking to you.
Thank you, Mel, and look forward to talking to you again.